All right, you're hot. You're coming in hot. Well,
yeah.
Breaking news.
Yeah.
Breaking news. Biden has announced his capital gains tax hike. I don't think this impacts any of us, but Biden will propose almost doubling the capital gains tax rate for wealthy individuals from 20% to, not 25, not 28, 39.6% to help pay for the social spending and inequality. For those earning $1 million or more, so nobody on this call, federal tax rates could be as high as 43.4%. The capital gains increase would raise $370 billion over a decade. Yada, yada. For New Yorkers, the combined state and federal capital gains rate could be as high as 52.22%, and Californians, 56.7%. Biden has previously warned that those earning over $400,000 can expect to pay more in taxes. This was just breaking news a couple of hours before we started the pod, and the stock market is down. And people are freaking out.
Jake, I want to hear your take on this, actually. I want to start with your take.
Why didn't you tell me Biden was going to do this? I would have voted for Trump. You didn't tell me this is going to hit me so hard.
No, Jake was ranting on this topic 15 minutes ago. We were talking, and I'm like, dummy, what did you think was going to happen? You know? He's sitting there going off. It's like, what did you expect?
Just before we get into it, we should do a quick primer on what this means, right? So capital gains taxes are the taxes you pay when you make an investment and you sell that investment at a profit. You pay a tax on the profit you make. And there's a difference between capital gains on the short term, which means less than 1 year, and long term, which means you've had the investment for more than a year. So economic policy historically has dictated that having a low capital gains tax rate relative to what an income tax rate might be incentivizes people to make long-term investments, and it gets more money moving in the economy, and as a result, the economy will grow. And so the idea of increasing the long-term capital gains tax from 20%, which it currently is, to 40%, is a real striking economic policy shift, rationalized as we're going to save, we're going to use this money for social spending. But I think the historical context and what this is really important as we get into the conversation. And just speaking historically, the maximum tax rate on long-term capital gains got up to 40%. Sacks, you probably have the history on this, in 1978 for a year, right? Or like 76 to 78. And then it's been largely, 15 to 20% for the last 20 years or so. And so to jump up, and prior to that, in the early part of the 20th century, it was like 25% pretty consistently for a long time. So to jump up to 40% is a really big shift. And there's a lot of debate around the economic implications of doing this. I thought that was important. Yeah.
Let's take a step back and actually see the forest from the trees. And the forest from the trees is that I don't think Biden thinks that it's a credible plan, in as much as I probably think he needs, this is like, it's performative, because it was a lot larger. The headline number was a lot larger than what people were whispering was going to be the number, right? It was supposed to be like in the low 30s or maybe kind of like, 33, 34. And then all of a sudden, like to come out at 39.6, I think it's almost like, okay, he's giving the pound of flesh to the left kind of like woke mob of the Democratic Party, who probably doesn't understand how capitalism works in the first place and doesn't care because they're not participants in it. Now, my reaction is, I don't think it's going to pass. I think it's going to be really tough to get done, and I think it probably, maybe there's a watered down version, but this version I'm not super worried about. And then it just comes back to the same thing over and over. The fewer the number of people that get to participate in the growth and see the upside, the more there are that just wants to just kind of, tear it all down. And so I don't know, it's just yet another signal that we have these structural issues to fix. It's not reasonable that a few people get super rich and everybody else gets left on the sidelines.
Sacks, what are your thoughts?
It's not going to pass, but it's not going to pass. It's not going to pass.
Sacks, is it going to pass? Is it an opening salvo where he wants to get to 32, so he's starting at 39?
I think it could pass, because I think they're planning to do this tax increase as part of the second infrastructure bill. It's not really an infrastructure bill. They're calling it human infrastructure. We've talked about this infrastructure is one of the last categories of federal spending that's still popular. So they're rebranding a bunch of social programs as human infrastructure. I think that bill will pass. I don't know if the rate will stay at 39.6, but I think there will be a big increase, clearly, in the cap gains rate. I mean, I think it's worth remembering how it got to 20%. It got to 20% because Bill Clinton lowered it from 28 to 20 as part of an overall package of tax reforms that he did in the sort of the mid 90s. And, that led to some of the best years of economic performance, GDP growth in the US, productivity growth, deficit reduction, and so, I think we are experimenting with breaking something that's been working, I think, pretty well since the Reagan Clinton years, which is to have, reasonably low taxes on capital formation and investment. I think it's a category error to treat capital gains or to think about it just as income. You have to remember that all of this money has already been taxed once, right? So you make the money the first time as income, you earn it, you pay tax on it, then you decide to save some of it and invest it, and then you get taxed again on that amount. And so capital gains is a form of double taxation. That was the original reason, one of the reasons to have a different tax rate for it. And I think that this risks kind of messing up the economic recovery that's really underway already.
By the way, think about what just happens to any organization that has to pay cap gains, right? It's not just individuals. Like last time I checked, organizations aren't exempt from cap gains, for-profit organizations. And I don't exactly know what they will do as well. So, you're putting a lot of people under a huge strain when you double the effective rate of return. So, if you're, for example, like a pension fund, right, and you have an enormous investment in a private equity fund or a hedge fund, part of these things is that, they're these complete pass-through vehicles. And so as long as you've structured yourself in a way where you don't have to pay that tax, I guess you're indifferent. But if you're any organization or institution or a person or a collection of people that bears that tax, all of a sudden, your returns have been basically cut in half. That's pretty nuts.
Let's talk about the average Joe for a second, or Jane, as it were. 401ks would take a hit here, and then when you go to your retirement and you have to liquidate them,
you don't pay tax on the
you don't pay tax on that.
You don't pay tax on the 401k gains during
otherwise your portfolio, because 401k is going to be a small amount you can contribute to every year. So retirees who happen to have stock market gains or cryptocurrency, people trading that.
Yeah, you'll basically pay the same as income tax as opposed to paying a lower tax.
So it'll
diminish investment, Jason. It's exactly what David says, which is that on a marginal basis, what will happen is inflation probably goes up because people just decide to consume rather than invest because they think, well, what's the point? There's already risk that I bear. And so, the earliest risk assets, right? The riskiest ones that we all participate in, which is early stage venture and company formation. You may not be thinking about the capital gains rate, but it's implicit in the returns that you're expecting for the risk and the time you're going to take. And, we've been trained to feel that rate. And if you double that rate from 20 to 40, I suspect that there's a lot of people whose risk tolerance changes and they're going to feel their after-tax gains differently. And they'll wonder to themselves, is this worth it? And then I think what happens as a result is entrepreneurship drags. I don't know if anybody's done an analysis, but I suspect part of the reason why America is such an amazing sink for capital, right? It absorbs capital all around the world, is that you've created incentives that get people very excited because they think they can get rewarded. If you take those rewards away, I think the implications are much bigger than just the cap gains rates here. Because as the people change their behavior, then the capital formation pools outside of the United States change their behavior. And the whole thing has a knock-on effect. And it was more muted in Clinton. It was less muted in 78. It basically didn't exist in the 40s and 50s, but it is a huge force today. I mean, we are an indebted nation that owes money to all kinds of countries around the world, including China. We're supposed to generate growth and sort of pay it back.
And where will the growth come from if LPs don't want to back venture funds or venture funds?
But
people say, maybe I'll check out.
Let's be honest and direct.
Yeah.
I mean, are any of you guys going to change your investment behavior if the cap gains tax goes to 40%?
No, but there'll be less of it,
Yeah.
So look, anything,
my behavior has changed.
I think my behavior will change. Yeah.
How will it change?
It's exactly what David said. So I just put in $100 million into a climate change company 2 weeks ago. Under this promise, I could only put in 50. So there's 50 million less progress that's going to happen on that business. I'm not sure that's the right answer for what that company is trying to do in the world.
And the way
you're saying the profits you would have had from before are diminished in half. Therefore, you would only have half as much money to invest as an investor.
Right. So however way you want to cut it, whether it's like the 10 companies gets cut down into 5, or the 10 companies that I invest in get half my money. The point is, at some point, the money starts to run out. Not just for me, but for everybody else.
Basically, at the end of the day, the money goes into the hands of government legislators and administrators to decide how that money gets spent, and it's not in the hands of capitalist investors to decide where to invest. That's the fundamental kind of shift that's going to happen.
Right. Capital's been taken out of the economy. Risk capital's been taken out of the economy, and it's now going to be spent by government. Look, anything that you tax, you punish and disincentivize, and anything you subsidize, you create an incentive for there to be more of. And, so this is just, we always talk about these things in terms of, well, who they're going to hurt. Is it that, that this only falls on the backs of rich people? So we shouldn't care. But the real question is, what is this going to do to the economy? And, I think we've talked in previous podcasts, the last pod that we had with Brad Gerstner, it feels like everything in the American system is kind of broken, except for one thing, which is this sort of opportunity economy that's being created by risk capital, right? And people creating new companies, like these big stultifying political corporations. The S&P 500 are completely broken. Government's completely broken. The federal debt is out of control. The media is broken. Everything in America is either broken or needs to be revitalized or reformed, except one thing is working really well, which is risk capital and its allocation to founders who have nothing but a good idea, right? And when all of a sudden you double the cap gains rate, that is an attack on that opportunity society. Now, I think there is a legitimate conversation to be had about how do we spread this sort of system of opportunity to more and more people. I think like Brad framed it really well in the last episode. Like, how do we get more people involved in that? I would submit the answer has a lot to do with school choice and charter schools, giving everyone in this country deserves to have a first-rate education. And so that is a very legitimate conversation to have. But I think to have punitive taxation on it it risks breaking that last thing that is working so well in the American system.
I think it's really well said. And I think this is going to take redomiciling to another level. I mean, if you're in New York or California right now and you were thinking about Wyoming or Utah or Texas or Florida, I mean, this kind of makes the decision for you if it does go to 40, and because would you get to neutral if you left? And so I
remember when I moved to the United States in 2000, the marginal tax bracket that I was in, and I was making maybe I was probably making $80,000 or $90,000 a year, was 55%. And I remember coming to the United States and seeing my take home pay, my first paycheck, and I was shocked because I was like, I was paying maybe 36% all blended in federal and local at the time or state at the time in California. And slowly it's creeping up with if you play it out today where we are, plus New York State just passed laws, you're going to be sort of in the 50 to 55%, almost upwards of 56% for certain folks. And maybe the answer is that's the right thing. But I think we have to acknowledge that there's going to be a bunch of unintended consequences. So maybe the intended consequence is to actually create more equality between the richest few and, not even the poorest, frankly, but it'll just be the richest few and the next richest few, quite honestly, because the investing class is still a small number of people. But the unintended consequences of that decision, I think, is exactly what David said, which is that over the next 5 or 10 year period, you will, at a practical level, see less investment. And the only way to make that whole is if the government then takes all that money and all of a sudden allocates it from their own coffers back into the economy. And we know that that's not going to happen well, right? That's just going to be riddled with waste and graft and corruption. So unfortunately, the setup is that you're going to really impact entrepreneurship. And then I wonder to myself, by the way, guys, like, what was the actual goal of this? Meaning there was 20 or 30 guys that were just making so much money on their equity. But then then we need to blame like these lists, like the Forbes billionaires list, because those are inaccurate, because a lot of these stuff is like realized paper gains.
Yeah.
Right. And so they're not paying any capital gains because they haven't sold anything. And most of these guys that are uber rich, have no desire to sell, because it's for them, it's a control issue to sell.
I'm not sure the consequence of taxing uber rich people is the true motivation. I think for some people, maybe it is. But if we just take a step back, I mean, a year ago, the US debt level was significantly lower than it is today. We've taken on a tremendous amount of federal debt to fund a series of programs that we believe were going to kind of keep the American population employed and keep our economy moving. That was a massive burden we accrued in the past year. So ultimately, over time, the only way to kind of support this new federal budget and this new servicing cost that we've taken on at the government level, you really only have kind of like three options. Option one is you're going to continue to raise more debt and massively kind of inflate everything, and the dollar declines in value. Option two is to reduce spending, which means starting to cut these programs. And option three is to raise taxes. And it's pretty clear that option one is one where we're kind of already at the economic limit. Option two is going to be very hard to swallow at a time like this. So you can't just cut spending right now. Across the board, so many aspects of the US economy and so many individuals in the United States are dependent on the federal government for support. And so option three is the only real one that's left on the table. And so then the question is, who are you taxing? You're not going to go tax the people that are struggling. You're going to tax the corporations and the wealthy. And the capital gains tax is the one place where you can kind of say, look, the tax rate that you're paying today is half of what an income tax rate would be if you were earning that as income. Let's get it to be fair and even. And I think just to argue this other side, like there's a motivation, there's a point of view where this is coming from. It's not just let's go tax the rich, screw the economy. It's that we find ourselves in a circumstance where we need to do one of those three things. The most rational to do is or the most kind of sensible politically to do is to increase taxation. And this is the first place to go, the most obvious place to go.
It's not, because so when you think about for example, you would say, okay, who are the folks that we're talking about? There can be entrepreneurs that are building companies. Again, they're never selling, so they're never going to pay these taxes. Like, it's not the case that Elon Musk or Mark Zuckerberg is all of a sudden going to write a $40 billion check, because that's not how much they make. That may be how much they're worth,
right?
But they will never sell a single share unless they have to fund some other project. In which case,
so which of those three things would you do, Chamath?
So what I was going to say is, And then you look at somebody else, like maybe you say, oh, well, the people that manage money, like, let's go after those guys, because like those guys shouldn't be, rich. But then the problem is those guys are already paying W-2 income. They're already paying nominal income tax rates. That's how the entire hedge fund industry works right now. You get paid in current income. And so, okay, so you're not getting their money because they're already paying at the prevailing rate. So again, this goes back to, if you actually trace the problem and see who it affects, it's exactly what David said. It's these folks that are in the middle that are actually putting the money to work, that are trying to invest in things that now have a very different return profile. And you're right. The core business that they do, they may still keep doing, but then all of the incremental things in the future that they want to do, they won't do. For example, look at all of the talk right now about how everybody needs to stand up, more angel investing, more minority investing, more women GPs, all of this stuff. Well, all of the folks, let's just be honest, all the folks that were in a position to put money into those folks are now 50% on a dollar weighted basis poorer if this thing passes. And I bet you what they're going to do is they're not going to cut their allocations in Sequoia. They're going to cut their allocations to all these other folks.
Yeah, that's exactly what I was thinking, Chamath.
Who's it going to hurt? It's going to hurt all the people that you want to get into the game. It's going to hurt all the people that are here. But the richest rich folks, that is not, unless
zero
you
impact.
Unless you expropriate the money from them, you're not going to get a single cent.
And then that was the concept of the wealth tax, wasn't it? That you would take the total value what you have and just take away 1% a year from Bezos's, or Zuckerberg's $100 billion. So would that not have been a better solution than this? If you had to pick one, a 1% wealth
Well,
tax
that's
for
a slippery
people
slope.
over whatever.
Jason, then we're no better than a banana republic that could also then expropriate a mine because we don't like the way that the mining is happening, or another critical asset because the government decides that it's important. I mean, what's the difference between a stock and any other asset that either a person or a corporation owns? It's very. I think that the definitions are thin. They're all